Welcome to Capital Decanted. In this show, we say goodbye to tired market takes and superficial sound bites, because here, instead of skimming the surface, we dive into the heart of capital allocation, striking the perfect balance and exposing the subtleties that reveal the topic's true essence. Prepare to have your perspectives challenged as we open up the issues that resonate with the hearts and minds of those shaping capital allocation. We've enlisted the wisdom of visionary leaders in the industry, and just like a meticulously crafted wine, we'll allow their insights to breathe, unfurling their hidden depths and transforming our understanding. This is Season 1, Episode 8 of Capital Decanted. I'm John Bowman.
And I'm Christy Hamilton.
And we, of course, are your hosts. A huge thank you first to our Season 1 title sponsor, Franklin Templeton Alternatives. With over 40 years of alt investing, $260 billion of assets under management, they've assembled and offer specialist investment managers across 6 different asset classes: private debt, hedge funds, real estate, digital assets, private equity, and venture capital. And of course, all of them operate with the client-first mentality that has always defined Franklin Templeton to prioritize investment outcomes. And stay tuned, by the way, for halftime. We'll be talking to one of those sub-managers today, Clarion Partners. So thanks so much, Franklin Templeton Alternatives. So, Christy, the OCIO, the Outsourced Chief Investment Officer, once a last resort option for subscale capital pools looking to avoid the hassle and the cost of building their own investment office. And yet today, a multi-trillion-dollar subset of the asset management profession, and arguably, as we're going to explore today, the hottest structural trend in the industry. So what insights and opportunities led to the creation of this segment of organizations? And why has that exploded in the ensuing 4 decades? What defines a successful OCIO? What do they actually do, and how do they really thrive? And why has that trajectory and evolution seemed to have reached an inflection point, hyperdrive, really, in the last 5 years that has redefined the space and encouraged newer, larger entrants? So that's our task today. We're going to examine all of this history and peek into the future on this episode of Capital Decanted. So, Christy, I want to get a visceral reaction, first of all, just to get us started here. When you think of the traditional OCIO relationship, what conditions do you think of with that asset owner, the client really, that warrants this decision to outsource? What comes to mind when you think of this?
Just the standard. It's going to be best for organizations under $1 billion that have relatively simple needs and objectives, and not a ton or no desire to build in-house investment staff, or doesn't have the resources or the time or the wherewithal, is the historic checklist for an OCIO user. What do you say?
I think that's right. I think certainly I've heard rules of thumb like $1 billion. That's probably the one I hear the most often, like you just cited. I've heard 2, 3, or even $5 billion. I think that's probably risen as the modern era has taken shape. I have chaired a few investment committees, and our main motivation for outsourcing were, I would say, not just purely size, and these are more recent. So I must say, to some extent, I think we're going to explore why this seems to have changed and evolved. But in many of the same ways, it wasn't just scale, but why would I pay 100 to 150 basis points for 60-40 portfolio of ETFs? I can do that myself. Treasury, CFO can do that ourselves. But if we want to build a private capital book, if we want expertise and access to these illiquid strategies, if you've got liquidity management issues or challenges in your asset allocation, then if you're under that $1 billion magic number, you probably need to look elsewhere and get some help. So I think it's certainly scale is the headline, but there's other challenges, I think, that the OCIO helps. So that's what comes to mind, at least traditionally for me. So listeners, I want to give you some trail markers as far as where are we going. I'm going to cover 3 topics in my segment. First, what were the favorable conditions that existed in the industry that opened a gap for the first movers, that created their insight into this space? And how did all of this get started? And second, I want to give you a flyover of the current size, structure, and scope of the industry, the here and now. Where have we come? And finally, we'll opine a bit based on our research and other surveys as to why we've seen such impressive growth over the course of those 4 decades, and why evidence and news flow suggest that this probably won't abate anytime soon. And then I'm going to hand to Christy to help us think through the decision process in a little bit more detail, the trade-offs of an OCIO relationship, and share her wisdom with us. So Christy, I have another question, a very important question for you. before we dive into history here. Okay, you ready? Who invented the internet?
Oh, Al Gore, duh.
Yes, good answer. You're on your game. By the way, I recently had a dream about Al Gore. We had this nice conversation at a cocktail party. It was the strangest thing. But I didn't ask him this question about the internet. But can you put an OCIO in a lockbox? I just couldn't resist that question, that layup. But no offense to Al if you're listening. But I realized through the course of this research that with most successful startups or new technological breakthroughs and trends, the credit for the original idea is always hotly debated, and it's often self-proclaimed as their own by several folks, and OCIO is no different. So the OCIO business origin story and its founder are about as elusive as the internet, or at least there are several bids and various revisionist history narratives that claim first mover advantage. So explicit attribution is a bit like water, or at least syrup running through your fingers. It's tough to grab with certainty. Now, as a quick preface to our attempt to piece together this elusive history, it's easy to forget that professional asset management, particularly for smaller capital pools, didn't really exist until the last couple of decades. Historically, foundations or college endowments were typically managed by mom and pop advisory shops or bank trust departments. And these were very much plain vanilla financial planning practices that rested in very conservative fixed income portfolios, perhaps a little bit of public equity thrown in to deliver some octane from time to time. And the tradition here, as I understand it, was that these small not-for-profits or family offices, they had their roots in philanthropic interests. So these partner institutions managed their giving and their tax optimization. So it just made sense to have them also oversee the investing bit. That was the residual. It was not the primary role or activity historically. But then in 1974, year I was born, I might add, things changed with the introduction of ERISA, so two great births in 1974. John F. Kennedy, 13 years earlier, established the President's Committee on Corporate Pension Plans that ultimately manifested itself into ERISA in 74. And that new act was a response to the systemic underfunded status of pension systems and introduced minimum fiduciary duty requirements, focus on performance comparison and benchmarking, and it gave broader interpretation of what types of asset classes could be included in these institutional pools. So suddenly, Christy, things that we know and are a bit of table stakes today, manager selection, bespoke customized portfolio solutions, specialty and more complex investment managers, these began proliferating and began to be in high demand. So deep investment expertise was therefore required to keep up with the pace of innovation and sudden pursuit of much wider diversification than all fixed income or even 60-40. And further, quicker, more informed decision-making also became imperative. Well, with no offense to my friends out there, deep investment expertise and rapid decision-making was not the zip code of the one-stop shop trust department or local corner advisor. And as a result, they began fading into the ether during the 80s and 90s, at least as an institutional solution, I should say. So keep all this backdrop in mind as we turn to a few of those parallel origin stories, because this is really the environment and the arena in which these founders and ideas really germinated and came to fruition. So I'm going to give you two of the most commonly held stories on how this was started and who started it, and then maybe a curveball third option. So a bit of suspense for you. So origin story number one, 1987. Group of senior staff members of the World Bank Pension Investment Division began to notice that their clients often felt like managing and growing asset pools within the institutions themselves resulted in complications around personality, conflict of interest, and serving multiple masters, and it just made the whole activity what they called inhospitable. So they left to form Strategic Investment Group. That might ring a bell, still around and still a major player. World Bank's CIO and SIG's founder at the time, Hilda Ochea-Brillemberg, conceived of Strategic as a, quote, investment department for hire, end quote, for institutions that needed expertise, resources, independent fiduciary culture, and scale to manage their assets. But they preferred not to hire their own CIO or build their own internal investment staff. Not all that dissimilar, Christy, from your earlier definition. Now, importantly, I want to stress this as we'll pull on this thread throughout the episode. Strategic and Hilda established itself on a couple tenets that really defined the first generation of OCIOs. And we'll see this in the more modern versions, that these have become hot button issues that get a little spicy. First, part of that initial insight that they felt strongly about was the conflict-free open architecture platform that seek to build GP relationships solely on merit and pursue a true best-of-breed approach with their clients. So there's no internal product development, no investment management function or prioritization around managers based on legacy, affiliation, or fee sharing. So that's one. Second was a belief that, quote, alpha doesn't scale infinitely, and the largest providers will often have trouble adding value. So while these teams are what they would call deeply resourced from an expertise perspective, these early flavors of OCIOs were deeply committed to serving a small number of clients, really intimate customer service. Now, as we'll see, as a bit of foreshadowing, as we'll see with the banks, consultants, and multi-strategy investment managers entering this space decades later with abandon, that has changed considerably in its modern form. So put a pin in this, and we're going to revisit this quite a bit later in this segment and with our guests. So that's number one, World Bank. Okay, origin story number two. About a year after Hilda's epiphany at the World Bank, two Goldman Sachs bankers had a similar revelation. And this was the quote from one of the founders. The core idea was to offer a diversified and full discretion money management function to family offices and institutions who could no longer effectively or affordably manage the money in-house. Very similar narrative there. The proposition, this gentleman went on, was that they could offer the proven performance of the best endowment and foundation investment managers at a reasonable price. And they could replicate the entire investment office with the process and structure to cope with the complexity of modern portfolios and mounting operational and regulatory burdens. So that last bit, as I think, is important and an evolution from the first one. And for the first time, this is important, they labeled this the Outsourced Chief Investment Officer. So these two individuals at Goldman were young Vice President John Hurdle and industry vet and mentor Don Callahan. And as you can probably now guess, that firm they left Goldman to stand up was the iconic Hurdle, Callahan & Co. So they weren't technically first, but it is certainly fair to say that they really pioneered the concept and certainly promulgated and coined the term OCIO that has really stuck, to say the least. So those are the most common origin stories that most people will cite. But there is a third alternative origin story, which rewinds history another 20 years from the late 80s when Brillenberg and Hurdle were cooking up their startups. Investment returns of college endowments in the late 60s were continuously failing to meet the operating budget needs of the universities in which they were managing for. The endowment finance offices at the time, as we alluded to earlier, did not have the capabilities, expertise, or even the tool set of asset classes to close this gap back then. And given that just like now, the returns of these capital pools fund a material portion of university spending, this dilemma understandably turned into a real existential question about the future sustainability of these higher education institutions. And by the way, this really rhymes with the same challenges that pensions were facing that we mentioned just a few moments ago. They were underfunded and with a huge talent and competency shortfall. So to address this issue, really interestingly, the Ford Foundation sponsored a seminal study that they called The Law and the Lore of Endowment Funds. Again, this is the late 60s. And this study explored the challenge and how total return, which was really a brand new concept back then, could be prioritized to address this critical issue. Well, as a result of this study, a grant for $2.8 million, almost $3 million, was awarded by that Ford Foundation to found the Commonfund for nonprofit organizations, or what we now call Commonfund, which remains one of the largest and most reputable independent OCIOs today. And today, Commonfund is led by one of today's episode's guests, of course, CEO and CIO Mark Anson, who, by the way, is a true founding father of CAIA. He literally wrote the first few versions of the curriculum beginning over 20 years ago. So Mark is on CAIA's Mount Rushmore. So we're happy to have him and chat with him a little bit later. So that's number three, and the less traveled of the common refrains, but the much earlier, perhaps, option for the origin. So it'll be interesting to hear Mark's side of the story, given he sits in one of those seats. But the truth is that these new segments are never straight lines or a function of one person's brilliance, but it's usually a lattice of insights and innovations and seedlings that grow together into today's reality. So no one should or can take full credit. So that's plenty to arm you with an imperfect but balanced history of where we've come from. We're now going to fast forward all the way up to today and give you a 10,000-foot flyover of the OCIO industry. So trade tables are back up, seatbelts are on. What does this now look like today? So Charles Scarina is probably a name most of you recognize that are listening. He's really the OG of executive search for asset owner CIOs and senior investment professionals. But he also is a content hub for fantastic industry data, and the OCIO space is a theme Charles has been on for years. So along with Cerulli, he is usually the go-to source for the market sizing data, and we've linked to that, several of his studies over the years in the show notes. So Scarina's data suggests that today there are about 110 approximately OCIOs, representing approximately 3.5 trillion in AUM. Today's OCIO provides some combination of a full range of customized front and back office investment services. So this is investment policy design, implementation, risk management, reporting, fiduciary education, and audit and tax support in some cases. Now, I gave you a brief overview of the 4-decade history, but it's important to note that the large majority of this 3.5 trillion has really come of age in the last 10 years or so, rising from the ashes of the GFC. In fact, the industry, and this shocked me, Christy, has doubled since only 2017, when it stood at 1.7 trillion. And more strikingly, despite these first mover independents that we've talked about, Commonfund, Strategic, Hurdle, and even some we didn't mention, big ones like Investure and Alan Biller, these collections of smaller independent players largely made up the entire industry as recent as 2013, and it stood at only a couple $100 billion in total AUM. So while the concept goes back a few decades, the stratospheric growth is very, very recent. Now, the other major evolution we're yet to talk about that is critical here is the new entrants over the last decade, which has really provided the main source of fuel, other than certainly capital market returns, for the industry literally delivering a 10-bagger in the last decade, to channel the old Fidelity portfolio manager Peter Lynch. And through sheer scale and M&A, these new players have begun concentrating what was historically what you might call a cottage or fragmented industry. 8 firms now manage 52%, more than half of that total 3.5 trillion AUM. Mercer, BlackRock, Russell, Goldman, SEI, Aon, SSGA, and WTW, the Gang of 8. These large players, who are master asset gatherers and acquirers, now each manage several $100 billion themselves each. And it's where the disproportional amount of the marginal dollar are being allocated. And Mercer, by the way, already with a sizable lead over number 2 BlackRock at about $350 billion, just further cemented its lead with a behemoth acquisition of Vanguard's OCIO business this past December, which adds another $70 billion of AUM. So they just acquired nearly the entire industry in 2013 in one acquisition, just to put that in perspective. So our original protagonists are now well down the list, with Strategic about $26 billion today, Hurdle at $20 billion, Commonfund at $12 billion. So these are now medium to marginal players, as the world now belongs to the institutional consultants, the large asset managers, and the diversified banks. And that brings me back to the pin that we stuck in our spicy history a few moments ago. Remember, I mentioned that Strategic established itself on the tenets of independence and intimate customer service, and argued that scale was not congruent with those foundations or sustainable performance. Well, one of our other founders, John Hurdle, penned a biting piece in the summer of 2021 called, I love this title, OCIO My Foot. How about that? So John, perhaps with a bit of sour grapes, but clearly echoing the original philosophy and vision that he left Goldman with 35 years ago, exhorted that we need to separate and eliminate what he calls the pretenders. In fact, responding to the Scarina data I cited a few moments ago of the over 100 self-proclaimed OCIOs, he wrote the following, quote, "Confusion created by widespread misuse of the term OCIO threatens to derail its transformative power. Growth in OCIO has attracted banks, traditional investment product firms, consultants, and startups who claim they too can provide OCIO services, despite structural conflicts of interest and cultural mismatches that disqualify them." That's a scathing and bold claim. John goes on to describe 3 requirements for eligibility for what he deems true OCIOs. 1, a conflict-free independent investment office. 2, talent and access that is unconstrained by purchasing power. And 3, an investment management culture. Now, he's doing something very intentionally here. The first 2, he vehemently argues, eliminates any Wall Street banks and multi-strategy investment managers. And the third disqualifies consultants. So applying this litmus test to the Scarina list, Hurdle eliminates 75% of that list, leaving approximately 25, quote, true OCIO firms. So we're going to tread lightly with our guests on that one, but certainly we want to unpack that a little bit. But any thoughts from you, Christy, on this claim of ineligibility?
Oh, I have a lot. It's funny because I think about a lot of the massive just market drawbacks that we've had and how big sweeping changes happen because you find out that certain banks were trading against their clients on other sides of the bank. And without naming names, there's a couple big ones that are probably coming to your mind right now. And so I do wonder, you can say in all of your meetings and in all of your slide decks that there's a wall there, but is there? I don't know. What are your thoughts on that?
I don't know. My experience in those investment committees I described earlier has largely been with the independents. And that's not to say I would never consider some of the big consultants or banks that I think earnestly try to separate, to your point. But I also think that's really hard in practice. So I have not had a lot of experience because my philosophy around OCIO is probably more consistent, maybe not as spicy, but probably more consistent with John Hurdle's as far as true independence. But I think clearly there's been a change in mindset. And as I said, with the marginal dollar going to all the big players, most folks are not thinking this way. So it'll be curious to see how this develops. So again, we'll pick this back up when we invite the guests in studio. Okay, finally, last bit from me. Should we expect this to continue? 3.5 trillion. I did the quick math on this, and we're talking a 10-year CAGR of greater than 40%. Yes, 40. You heard that right. 40%. And there's a narrative in here that says, well, 3.5 trillion is a lot, especially given that it's been such a short period in which that has developed. It's still a tiny fraction of the total investable AUM. So our CAIA numbers, for example, outline a global investable universe of about 150 trillion US. And based on recent studies, the retail or the high net worth investor is about half of that. So in round numbers, if 3.5 trillion of the 75 trillion of institutional capital pools are currently outsourced, that's only a 5% penetration. So there's a lot of room to run here. Now, technically speaking, you could argue 3.5 trillion is nowhere near saturation. Institutional quality full service asset management is expensive and probably growing more so. Human resource talent, access and expertise in illiquid and alternative asset classes, not to mention infrastructure and tech costs, cybersecurity, and regulatory and compliance audits are only going to make the calculus worse. So outside of mega scale asset owners, outsourcing is increasingly, I would argue, attractive. And recent surveys by both Cerulli and CIO Mag, as well as Capgemini's wealth management top trends, highlight large percentages of respondents that currently insource. These are asset owners that are now increasingly considering or strongly thinking about the OCIO model. So Laura Levesque, an associate director of Cerulli, stated about that recent study that they've just released, quote, amidst inflation, interest rate hikes, market volatility, and the changing implications of geopolitical conditions, asset owners are increasingly drawn to the OCIO model for the management of sleeves, for alternatives, and private asset classes for which they do not think they have the appropriate level of expertise. And Capgemini added, quote, the growing complexity of assets, the necessity to adjust to volatile markets and uncertainties, access to experts, and shrinking investment management costs will heighten the profile of OCIOs. Now, Christy, at the beginning of this research for me, I would have then thrown this huge wet blanket. I would have thrown this all out here. It looks bright. The surveys suggest there's more to come. But then I would say, well, wait a second. Because historically, we need to realize that the larger pools around the world that represent the vast majority of this 75 trillion have actually been trending the other way. So let's take the Canadian, the Norwegian, the Aussie, the Kiwis, the US pension models, increasingly even. They've accelerated their insourcing of investment management talent to both save management fees and bring the expertise, what they would say is closer to the capital. And sovereign wealth funds have largely pursued an in-house model as well, given their asset size. But wow, I must admit, the last couple of years have blown up that formula, have changed the narrative. And this, while it might have only made sense historically as we begun this episode at 1 billion or even below 5 billion, larger and larger pools of assets have gone this outsourcing route. And often they will transfer the entire teams to the OCIO. And this has changed the whole dynamic completely. So let me just put a couple exclamation points, examples on that statement. BlackRock announced in June 21 that it had been hired by British Airways for a 22 billion pound, that's about 27 billion in today's dollars, OCIO mandate. 27 billion. BlackRock, again in 2002, added 14 billion from General Dynamics pension and 42 billion, which is the largest I've seen, Teamsters Central State Pension Fund. National Grid outsourced to number 2 Russell its $16 billion plan, and Goldman won the $10 billion Motorola pension plan. Goldman also more recently, this is very recent news, won the $29 billion BAE Systems pension, the largest UK outsourcing mandate ever in history. So that has opened up my mind that maybe that original motivation is much more complex and nuanced than it used to be. The players that are now seeking and gathering and proposing outsourcing are telling and spinning a very different story than those original few independents. The major players are going big game hunting, and this may change the entire trajectory of the industry. So, Christy, I'd love to hear from you, maybe elaborate a bit on a couple of your answers through the course of my segment on how you think about the trade-offs of this decision tree and maybe some of the pitfalls that we're not considering.
I'd be happy to. So I think that this is a difficult topic in that there's a tendency, and John, you touched on this, to discuss OCIO as either all good or all terrible. But it's not how I tend to look at it. And I think that the all terrible side of it has a lot to do with these handful of organizations, probably 4 or 5 years back, that had poorly managed transitions from in-source teams to more OCIO models. And it was more about the transition and the lack of perceived fiduciary duty in the decision-making process versus the actual OCIO decision itself. So going back again, almost nothing in the investment world is either all good or all bad, so long as it fits within acceptable standards and regulations, et cetera. And to me, it's much more about trade-offs. So on the positive side, the offerings of OCIOs are increasingly customizable. It's no longer just you have to invest in our pool, but with that comes this lack of autonomy and the fact that you don't actually own any of the relationships with your managers. So building on that, if something happens with the OCIO or they decide to cut off a manager that is actually really important to your organization, you don't necessarily have the autonomy over that. So with the good can come the bad. Also within that, positive is that you have the resources, both operational and governance platforms that function as a second check or function as extension of staff even, in theory. But again, with that could come conflicts and agency issues as you consider that you are no longer the single client of an in-source team. You are now one of 100 or anywhere from 3 to 150 clients of this large OCIO group. And if they have a bite-sized allocation to an amazing GP, are you going to get that? And it depends on where you fall in that relationship. And so it removes the investments, in my opinion, from the core objectives of the organization in some ways, as manager selection is a lever of ultimate performance. From there, I will say execution can be quicker with an OCIO, particularly depending on how your governance is set up as an organization. And it can also have the added benefit of focusing either your board or your investment committee on the actual governance of the program and the organization versus in manager selection or a lot of the other nitty-gritty details that boards can sometimes get caught up on. But with that, you also have a couple of OCIOs have gone out of business and have left their clients high and dry to an extent. So it can be a hassle if that happens. Obviously, then you have to go through another RFP process. You don't own your managers, so I don't know exactly what happens with the investments there. But then you also have the onboarding of transitioning to that and just the business complexities of that within your organization. But it can be good. As we've discussed, it can be good for organizations with limited resources. But once more, it comes off with the trade-off of if you're one of 150 clients, are you getting the best communication? Are you getting the best and most reasonable understanding of what's going on in your portfolio at any given moment when you have an OCIO that has a lot of clients and you may or may not be their single priority, particularly British Airways, their $22 billion as another client. So one thing I will point out that I didn't include on this pros and cons list is fees. And I have my own personal hot take there. I will get to it in a minute. But broadly speaking, I do want to take a step back. And if there's one thing I've learned about investing and managing multi-billion-dollar pools of capital, it's that, well, it's not rocket science, or it may not be rocket science. I don't know. So for some people, it might actually seem like rocket science, but it is a very involved process. And an in-house investment portfolio, for better or worse, is the result of hundreds, if not thousands of hours of work, both in the initial construction as well as the ongoing investment and operational management. And not to mention, it takes even more work at every level of the team than even what an external stakeholder might expect. So there's a lot of behind the scenes processes and stuff that people just don't see. So building on that, I'd say the second thing that I've internalized is that the endowment model isn't a load up on alternatives and complexity as a price taker and hope that we see results. Particularly over the last 3 decades, I don't even know if the next 3 decades will mirror that. But I think building on that, the model is more so about understanding the needs of the organization. Obviously, that's first and foremost when you're building a program and considering OCIO. And then from there, developing an investment program based on the objectives that will actually meet those needs. And then just as importantly, I'd say the third thing would be ensuring the execution and day-to-day operations of the program not just fit those needs, but also they fit within the resources that you have available. So consider the objectives and needs relative to the resources to meet those needs. And that should be what drives any decision as to whether insourcing is right for you or outsourcing is right for you. So as I think about the investment program itself, then there's three main levers within that, which you and I have discussed before, John, and that is manager selection, market timing, and asset allocation. So in my opinion, if you think you have a competitive edge or an advantage in any one of those three spaces, you really should consider insourcing because you have that ability to add value above and beyond what even an OCIO might be able to add. So it was actually funny because when I came up with this next list, I was thinking about the old Jeff Foxworthy, you might be a redneck if, but consider it more as though, you might be a primary candidate for OCIO or a good candidate for an OCIO relationship if you are a relatively small organization or really an organization, to your point, John, at any size, but with limited internal investment staff, with a relatively center of the fairway needs. And if you can get comfortable with those drawbacks I mentioned above, then again, you might be right for an OCIO relationship. If the investments are a very small part of the needs of your organization, you might be a primary candidate for OCIO, particularly if it's just a small part of your board meetings every year. That might be a time to look for it or look into alternative options. But if you have great access or you have a team that has great access and great manager relationships and the internal professional expertise and time to maintain a more, not just diverse portfolio, but a more organizational specific portfolio, so a portfolio that is more specific to the needs of your organization, you might want to consider insourcing. If you have access to amazing manager relationships, and by that I mean you have a board that has access to really great GPs and can introduce you to them and get access, absolutely consider insourcing. I think that that's a big one that people forget about is that while boards maybe shouldn't be involved in the day-to-day manager selection, the relationships maintained and the ability to introduce people, I think is a huge competitive advantage that I think sometimes board members inadvertently take themselves out of when they really shouldn't. So that's the big thing, again, is just thinking about the needs and the resources of the organization when you're building it out versus fees. So my hot take on fees is that I think that everybody looks at fee modeling, and I think to the detriment of the broader investment complex, particularly in 401k programs and such, the legal system has placed a big emphasis on fees and the importance of them and the ability to sue if fees are above really any level above indexing. And I think that that is a complete misunderstanding of fiduciary duty more broadly. I think that typically if you are choosing the cheapest provider, often you get what you pay for. And I didn't want to say it so bluntly because there are times that absolutely we are overpaying. I think that the standard, this is market rate that we use for managers sometimes, I think is overpaying. But I do think that if you have relatively comparable products and relatively comparable offerings, maybe you look to price as something that informs your decision. But I think any fiduciary who makes a decision based solely on price is making questionable fiduciary decisions. That's my opinion, though, I will say. I'm just going to go on and build on my hot takes now, because I think my second one is this idea that you have to go to OCIO because you need alternatives in your portfolio and you're a small organization. And I think a lot of the push for alternatives was historically because we had to get return. There was no return because rates were so low. And so it pushed us out on the risk curve, so to speak. And so there was this huge appetite specifically for these kinds of investments. And now they've become embedded and we see the benefits of them in a lot of ways. But I do think that there is this, oh, everybody else is doing it mentality. And I think that's the mentality you have when you're making this decision. You should probably pause and actually ask yourself if that's what the needs of your organization actually demand. I've noticed a lot of healthcare institutions in particular have been really focused on this. Do we really need to maximize our performance when our goal is just to return greater than our cost of capital, particularly for longer term projects? So I think that a lot of people are recognizing that, but I do think that as these offerings become more widely available to an increasing number of investors, that asking themselves that question is actually really important. And then, John, one that just hit me as you were talking was one of the biggest considerations, and that's just the regulatory nuance, if you will. I do wonder, as large corporate pensions, for example, decide to move to OCIO, if that divorces the true, what's the word I'm looking for, responsibility of a lot of these investment decisions and governance and fiduciary decisions that OCIOs may not be prepared to take on. And by that, I mean, for example, risk transfer was a huge thing at a certain point a few years back because of rates and just where pricing was. But I can't imagine a third-party institution saying, hey, this is a good idea to reduce our AUM to do better for your organization. So those conversations may not even be had because again, it's at odds with the goal of the OCIO themselves. And even beyond that, as I think about it, I just realized it'd be really hard to maintain the due diligence of that when the investment decisions are so dispersed or so far away and divorced from the actual day-to-day management of the organization. I don't know. I would just pause there before I made any decision as a board member and be really concerned with that, because particularly if the CFO, and I know that there are regulations around this part, if they wanted to put a bunch of corporate stock in there, if they wanted to do stuff, I don't know if you are paying an OCIO. I would hope that an in-source team would be the last point and saying, hey, we probably shouldn't do this. But I don't know actually who would be better there. And that was my less developed thought as you were talking of just, that would be a risk that I would not have considered, particularly for pensions. But I don't know. Overall, I agree with you, though. I think that the people who are involved are professional. I don't think that anybody comes in with malice. I think that they really love the organizations that they work with. I can speak for that personally, having worked at Cambridge and known that. But it is trade-offs all the way down. It truly is. And I'll stop there for a moment.
No, I think that's so helpful. I think, look, you said some really important things. And look, smart people could quibble about access. Is it better to get and more favorable to get access to these illiquid complex managers through your own or through an OCIO? I think Hurdle and Commonfund would argue, and through experience, I think I'd largely agree with them. They've got as good of access as even the Ivies from an endowment perspective. That would not be the case for all 110, but there are a few that I think could make that case. But look, I think more importantly, what you said is this can't be a single issue decision. This is not just about cost. It's not just about building an alternative book. If it's just that, you've missed the larger point. And I think your one warning that was most resonant to me was this idea of you can't outsource your mission. And the moment you start disentangling even a well-meaning outsource of your investment and financial management, by no means is it terminal, and can you not overcome it through, I think, really strong communication and collaboration and governance tactics. But it's really hard to align the organizational, particularly not-for-profit mission with the investment operation when it doesn't sit within your walls. And look, these OCIOs are very good at this, and they would probably disagree with that. And I know they work hard to represent that mission in their culture and in their decision-making. But we just need to be honest. That's a trade-off too. If it doesn't sit within your walls, it will never have the aura and the DNA completely that I think it would if you had your own investment division. So we will leave it there. That is, I think, really good intro and background to help us think through a rich discussion with Mark and with Sarah, who we are going to invite in studio momentarily. Before we do that, however, as always, we are going to talk to Franklin Templeton. And as I promised, we're going to talk to Rick Schaup, partner and portfolio manager of Clarion Partners Real Estate Income Fund. Clarion is one of several of those sub-managers we've been mentioning that's in the Franklin Templeton family. So stay tuned. We'll be right back. Well, welcome back to Capital Decanted. As promised, I am here with Rick Schaup, who is partner and portfolio manager of Clarion Partners Real Estate Income Fund. Rick, welcome to Capital Decanted.
Thank you, John.
Really excited to spend just a couple minutes with you. I think the listeners will really benefit. But Clarion at least came to Franklin Templeton through the Legg Mason deal, which closed a few years ago in the height of COVID in 2021. It looks like you've been there almost 2 decades, if I have that right. And Clarion in particular, very diversified real estate asset manager across both segments of real estate, but also geographies, increasingly in Europe as well as in North America. So with that brief introduction, tell us a little bit more about Clarion's footprint, your set of strategies, and your scope.
Sure. Thanks again, John. It's great to be here. Clarion is $80 billion assets under management, been around for 40 years. And we really provide private real estate as an investment into folks' portfolios, historically more institutional capital. And that's obviously been transitioning over time. And obviously the partnership with Franklin Templeton towards the more individual investor. Our strategies are across property types, across regions, the US, Europe, but we have focused on more multifamily and industrial as we've seen those sectors begin to really outperform. And the firm has been well positioned to take advantage of that.
And Rick, we've spent a lot of time on this show talking about the democratization. So it'd be really interesting maybe in another time to talk about the family office and the high net worth pursuit and their vivacious and energetic interest in these types of strategies. As you think about clients in particular, which as you said, traditionally is the more larger, long-term institutional pools of capital, how do you think about client profile? And I know I'm asking you to diagnose what are several strategies across several flavors of clients, but When you think about a long-term portfolio and the contextual fit of your set of strategies within that long-term portfolio, how should clients think about that?
Well, we've really attempted to bring the benefits of private real estate, which are strong income, low correlations, low volatility, true portfolio diversifiers, to a variety of clients' portfolios. If the traditional 60-40 bond portfolio has challenges in its correlations and can have periods that are more correlated and up and down, private real estate can be a nice ballast to that portfolio. And that's why institutions have invested over 10% in private real estate. And we're really, as you said, democratizing. We think now with technology, the platforms that we have, we can actually bring this asset class at a reasonable fee basis to a broader client universe, which allows more folks to essentially improve their efficient frontier. And if you add 10% of core private real estate to a traditional stock bond portfolio, you can improve a risk-adjusted returns by 20% really throughout any stock bond portfolio. So that's really what we're passionate about. We're passionate about just continuing to expand our client base, bringing this in appropriate ways to a broader group of people, which, as you point out, includes RIAs and throughout the private wealth space.
And that incremental risk reward benefit is really the entire purpose of diversification. I think you guys are doing a great job at that. And listeners, I just would encourage you to check out Clarion Partners with their long history, their legacy, their diverse set of strategies, as I said, across both segment and geography. And now with the tailwind of the platform of Franklin Templeton, I think it's a really good marriage and exciting opportunity. So Rick, thanks for spending a few minutes with us. And I look forward to talking to you more in the future.
Thanks, John. Appreciate it. Talk soon.
Welcome back to Capital Decanted. As promised, Christy and I are now here, and welcome into studio Mark Anson, CEO, President, and CIO of Commonfund, and Sarah Samuels, partner at NEPC. Mark and Sarah, welcome to Capital Decanted.
Thank you.
Thank you. It's great to be here.
Well, I was so glad that both of you accepted because as we were talking in the green room and as we were preparing for this episode, you guys represent two stakeholders in this journey that we've just laid out for listeners over the last 35 plus years. The independent, the traditional player, and then the consultant who has come to represent a huge chunk and some of the top of the league tables, you might say, more recently. So I think we'll see all facets of this movement, of this new structural change. And I'm just delighted to have you both with us to help us learn and pick apart what we learned in the history. So Mark, maybe on that history, I could start with you, if that's all right. We spent some time in the intro segment discussing the history of this OCIO model. And I joked a little bit that like the internet, there's lots of claims on who invented this. But regardless of who that first mover was, it almost doesn't matter at this point. It certainly has come of age, particularly in the last decade. But I'd love your view as Commonfund, one of the earliest players in the marketplace. I'd love your view and your seat on your perspective on why and how it was created. What vacuum did it enter into? And what does the modern form of OCIO mean?
The history, or at least our history, is interesting. Certainly, I like it. Commonfund was born with a $2.5 million grant from the Ford Foundation 52 years ago. And back then, the idea was, let's put together some organization that could help endowments and foundations better manage their wealth. And again, 52 years ago, they held mostly bonds and money market funds, short-term cash. So the very first product the Commonfund came up with, going back again 50 years ago, was just a multi-strategy equity fund, so that large endowments and foundations could outsource the selection of equity managers and get equity exposure into their portfolios. And then over time, that began to expand. So that goes back to the 1970s. Starting in the 1980s, Commonfund began offering private capital solutions, private equity initially, then venture capital, because that was the next wave that was demanded. I think the whole idea of an OCIO really started with the popping of the tech bubble. At least for Commonfund, when we go back to the early 2000s, that's when we started to see clients coming to us and basically saying, can you take over all of it for us? Not just stocks, not just bonds, not just private capital, but the asset allocation and the strategic allocation, as well as the tactical, as well as all the reporting and accounting that goes on with that. Can you take all of that on for us? So again, it started with small bits and pieces. Let's start with just a multi-strategy public equity fund. Then that's 50 years ago. Then 40 years ago, let's add some private capital to that. And then 20 years ago, gosh, can you take on all asset classes and all the reporting and all the logistics that goes with that and all the strategic asset allocation? So I think when we think about the modern OCIO model as it is today, I'd say that probably starts and traces itself back about 20 years ago.
I really love that context. But as we think about this more recently, Sarah, we've seen OCIO assets balloon to over $3 trillion. And it really seems as though the institutional consultant companies have become the major players in this segment in particular. Why was this a natural extension of the advisory relationship, and how has it changed your business at NEPC specifically?
So at NEPC, we've been investing money in our OCIO business for over 10 years, roughly 10 years ago. And it was really an evolution of our advisory clients who knew us really well and trusted us and knew that we knew what we were doing, converting from advisory to discretionary, or OCIO, use those terms interchangeably. And that trend continued. And today it's a combination of roughly equally split. The clients that we bring in are half advisory and half OCIO. And people are coming to us for different reasons. Things we add value the most in is when there's a situational change at the client. So what are some examples of that? Well, a pension could have a treasurer that's retiring, and the company doesn't want to replace that headcount with that experience and skill set. They want a junior person, but they really can't get the work done with a junior person, so they outsource it. Or if we think about healthcare clients are completely agnostic to the model, advisory versus OCIO, but they identify themselves with really the technology that they bring to the client. So where we have been really successful in speaking with clients and showing what we can bring to bear is that we have an independence, we're a private partnership, and we have a singular focus. So we don't have any conflicts, we don't have underlying funds, we don't make money in any other way than how our clients pay us. And we are also agnostic as to what service model our clients want. So we'll meet them wherever they are. We also have a spectrum where we have full discretion, limited discretion, and then an advisory. When you think about some of the challenges that are facing clients today, they're really struggling to manage their administrative, operational, back office data. Committee-run pools of capital really can tend to be overly bogged down in the tactical management, whereas a committee's highest and best use is really strategic matters like asset allocation, IPS construction, and risk management. But when we think about what is facing allocators today, whether it's committees or internal staffs, staff and trustees are really faced with an ever-growing rock of information overload and task overload. That's the legal, the regulatory adherence, the administrative oversight, all with pretty meaningful internal budget constraints. These are not organizations that have unlimited pockets and deep pockets to pay their employees. In some cases, they can, but in most cases, there are some pretty big budget constraints. So the rock is growing for these clients, but their hammer has gotten smaller. So OCIO can really offer a solution to many of these clients, and I see this trend continuing.
And I want to make sure we pick apart that future trajectory, Sarah, that you just noted. I think both of you gave really great context to the seat and the purview by which each of you come to this challenge and opportunity. But Mark, I've known you for a long time, and for as long as I've known you, you've been as much of a teacher as you've been an investor. I mentioned in the introductory segment that you are on really one of the founding fathers of CAIA. And I also joke when we're on stage together that I can't shake you. You were on the board of CFA, you were on the board of CAIA. I can't get rid of Mark Anson as much as I try. And of course, you have been a gift to me and to this industry. So I'm not going to ask you to play teacher again for a moment here and level set us and the listeners on how to think about just the definition and the competency set around today's modern OCIO. What does the service entail? And I think you could talk, if you'd like to, a little bit about how that has evolved and broadened in the time that Commonfund has existed.
Thank you, John. I guess I do feel that holiday relative that just won't go home after the holidays. You just can't get rid of them. Like Cousin Eddie from the National Lampoon Vacation movies, if you remember those. You just can never get rid of the guy. So jokes aside, first, I think Sarah raised some really good points about some of the complexity of the OCIO model today, the regulatory complexity, and the difficulty of just managing through all of that. You do require staff to have it. Everyone wants to talk about picking investments and picking stocks and picking managers. Well, that's part of it. But a critical part of a successful OCIO model is having a very strong and back and middle office that can follow through all the compliance checks, all the regulatory issues, do all the reporting for you. We actually market that as an advantage at Commonfund. And again, I know this sounds a bit like a commercial, but we don't outsource any of that to a third-party provider. We keep it in-house so that it's controlled and accountable to us and our clients. But it's critical to be able to have that back and middle office, to have all the supporting functions that you need that go along with picking stocks and asset allocation. So that's one. Got to have a strong back and middle office today to be successful in the OCIO world. And I think Sarah made very good points about that. The second goes back to strategic asset allocation. You really do have to be able to put the building blocks together of what's the right blend of asset classes, both alternative and traditional, that will get you to the risk and return objectives for that foundation, that endowment, that pension plan, or even that high net worth office. And then secondary to the strategic asset allocation, you should have some framework or format for when you're going to make tactical bets. Now, everyone loves to time the market. Everyone loves to talk about the time how they made a great call on a currency or a stock or a bond. They forget about the dozen times when they didn't do so well. So you need a very rigorous process not only to establish your strategic asset allocation and how you're going to put all those building blocks together, but you also need a rigorous process on how you're going to rebalance them and when you might decide to overweight or underweight risk asset classes. What's your process, your procedure for doing that? So that's the second part of the puzzle. The third is you have to have a team that's very good at manager selection, being able to find those good managers that can generate alpha and bring those into the portfolio. And then last, I think the fourth critical component is having access to and finding those great private capital managers that will bring in the liquidity premium into your portfolio. And when I say private capital, that's private equity and in growth capital, that's venture capital, that's real estate, that's private credit and natural resources. One of the things we've done at the Commonfund is we published a research paper about 6 or 7 years ago where we identified the liquidity premium. And that's the premium you get for allocating to private capital. It's the premium over and above the public equity markets. Now, the catch is that liquidity premium cannot be captured passively. There's no ETF, there's no index fund, there's no swap instrument that will get you that liquidity premium. The way you get it is by finding very good private capital managers and getting access to those good managers. So that's another very critical part of the OCIO model. So those are the four key components. Again, strong back and middle office, 2, very thorough strategic asset allocation process, as well as tactical. Then you have to have good manager selection, and then you have to be able to demonstrate that you can access great private capital managers and capture that liquidity premium for your clients.
Those are all really interesting points, particularly as you think about the complexity and the increase in complexity that these organizations take on as they manage larger and larger pools of capital. So again, thinking about that, the traditional rule of thumb, if you will, has been that outsourcing is considered the cost-effective and even wise decision below $1 billion. And then above that, it's more likely and possibly even better to build that internal investment program. This is from the LP's perspective. However, John and I had a discussion earlier about how this more recently flies in the face of groups like BlackRock, who have now scored mandates well over $1 billion with groups like British Airways and General Dynamics, and the other one was Teamsters. So, Sarah, I'm curious, how would you describe the conditions and the decision tree for insourcing versus outsourcing today based on that complexity and just the broader needs of the organizations?
It's such a good question, and I'm going to answer it from a couple of different perspectives, including my perspective as an LP, both at a public pension fund and at an endowment before joining the consulting world. So before I do that, I really just want to take a step back and remember why we're all here and the importance of our work. And the power of capital is tremendous. It is really important that we get this right as an industry. That capital is helping retirees live comfortably, including my mother, who is in the state pension fund in Massachusetts, and my father, who has a pension fund with Raytheon. Capital helps hospital systems care for the sick. It helps send first-generation kids to college, and it helps to fund innovation and change and really lead to all sorts of impact that we need in this world. So we cannot afford to get this wrong. And our jobs as fiduciaries, as stewards of this capital is really, really important. And when you think about this decision tree, it's really all about what is going to lead to the best outcome for these beneficiaries. So to be more specific, this is a world of doing more with less. We're all feeling the impact of that, whether it's fee compression or service models demanding more. But an OCIO model really allows offices or committee members to focus on more value-add issues. And this is really true in the corporate space. So the OCIO model fits really well into the corporate space. From a business point, it's always healthy to offer service where you're providing something that the OCIO provider can do things that the client cannot or doesn't want to do due to their size. When we think about other areas, I'll speak from my experience, actually not as an LP, but as a committee member, as chair of an endowment investment committee for 6 years. This would have been a prime candidate to consider outsourced CIO. This was a pool of capital that was relatively small. It was committee run, and the committee liked to meet with investment managers before the hiring or firing decision was made. So we would make all sorts of scheduling and arrangements to meet with managers nearly all the time. They wanted to make tactical trades. One donor had given a large amount of money and didn't believe in non-US equities. So there was a lot of discussion that we have to keep this person's opinion in mind when managing the investment portfolio. A lot of baked in conflicts here, especially with a volunteer committee. And also in universities, you have situations where maybe the president is going to make less than the CIO. So there's a lot of things going on here that could really contribute to the decision to insource versus outsource. At the end of the day, a committee's highest and best use is really to think, as I said earlier, about strategic asset allocation, about risk management, and about the IPS and spending policy. And when we think about how that example of that investment committee that I worked with, we were spending a lot of time on the more tactical things that really didn't belong with a committee. So when you think about insourcing versus outsourcing, it's really hard to imagine a world where insourcing would be better with a volunteer-run pool of capital when you have 30 people on an OCIO team and 70 other investors at an OCIO, for example, looking at your portfolio. So we have large plans, we have smaller ones, we have $80 billion in total OCIO assets, and we have lots of plans that are in the larger end as well as a lot of smaller ones. So that's about it for that.
And I think, Sarah, you alluded to something that I think is important too, and why I think listeners will really benefit is because you mentioned Wellesley College, Mass Prim, your experience. Mark ran CalPERS. So you have sat on the other side, and you've sat on several other sides of this decision. You've watched this from several seats. And so I think really have a real precise and pristine and multifaceted perspective on how this all works. I want to get, as I promised the listeners, to the spicy side of the discussion that we've alluded to in this evolution, because historically, as Mark described with Commonfund and as we described with places like Hurdle and Strategic that started this whole movement, originally it was small independents. And John Hurdle, who many call the Oracle of outsourcing, recently wrote this article in 2021 where, a little bit of hyperbole, but he said, OCIO my foot. And he claimed that, quote, true OCIOs, these are John words, must be conflict-free, have sufficient purchasing power, and have an investment management culture. Now, what he was doing in those three tenets and conditions was eliminating 75% of the players on those rankings that I referred to. So Scarina suggests that there's over 100, maybe 110 OCIOs. And John was basically saying, look, there's really only about 25 that carry these three conditions. Clearly, we all write self-serving articles, and perhaps some of this is sour grapes, how the world has changed, and this has come of age in many ways. Maybe I'll start with Sarah, because you sit on the consultant side, but I'd love your thoughts on how you might respond to something like that. I imagine that there's conversations with clients that say similar things that you have to debunk certain myths that exist with consultants like NEPC.
Absolutely. So I'll take each of his points in turn. When it comes to being conflict-free, we agree. We think that's really important. So as a private partnership, we're not owned by a parent company. We don't have growth or revenue targets. We don't have a public stock price to consider. We don't charge additional fees for access vehicles. And we don't take any money from the asset manager or GP community like some other consultants. When it comes to purchasing power, that's also really important because I always say alpha comes and goes, returns come and go depending on the market environment. But a basis point in fees saved is going to be good year in and year out, and that's going to compound over time. So purchasing power is really important. We are able to consolidate our assets and our meaningful scale, including what comes from advisory behind us. So that $1.6 trillion to negotiate fees on behalf of our clients. And we've saved our clients $70 million a year in management fees across all of our asset classes. And that doesn't include carry or incentive fees for private markets and hedge funds. So having that purchasing power is really important. Access is also very important and something that any allocator or LP should be looking at. Ask who it is that the OCIO team is able to get in the venture space and the growth equity and on and on. I joined NEPC 5 years ago as someone with a lot of experience on the investment side at Wellington Management Company, as a PM at a quant shop and an allocator. And the CIO, the investment mindset, really is critical when you're running an OCIO business. So you want to really look at the composition of the team. They folks who grew up in the world of whatever it is that that business is, the OCIO business, or were they practitioners actually doing and running the capital? And so We have a team that really has been there and done that, and that's really important. We serve on investment committees. You want to see that certainly in the team composition that you're looking at. We understand all the dynamics at play and the different decision-making requirements and the execution and implementation, because getting it done is a lot harder than talking about it. So that CIO mindset is one of the key tenets that I have with anyone that I'm looking at hiring.
And Mark, in full disclosure, I mentioned in the introductory segment that I've been on a couple investment committees. And as you know well, personally, we actually chose Commonfund with one of those. And I asked questions like this that I'm sure Sarah can understand and you can understand. Tell me about your independence. Tell me about your manager selection. Tell me about the relationships or previous affiliations, legacy with said investment managers. I have to imagine that part of Commonfund's narrative, or at least a lot of the dialogue that happens in the process of semifinals, finals presentations, is around these types of tenets that John Hurdle is laying out. How do you position Commonfund around these foundational elements?
Actually, it's very easy for us. Like Sarah and NEPC, we have no outside shareholders. Commonfund was founded as a not-for-profit, and we still remain to this day a not-for-profit. So we serve only our clients. We have no outside constituencies to create any conflicts of interest for us. So on that point, agree with John Hurdle. That gets to the conflict-free. The second part about an investment culture, that's all we do. Our AUM is approximately $33 billion, but it's all assets under management. It's all invested capital. We have no other lines of business at Commonfund. All we do is invest. That's who we are. That's who we've always been, 52 years running now. The last part, though, about scale or cost savings, I agree and disagree at the same time. Let me explain where I agree. Certainly for like back or middle office that we talked about earlier, scale there helps a lot. Having a strong back and middle office team that can help you with all the reporting and compliance and regulatory issues, scale does help there. But if you're talking about scale in terms of finding good managers, that really doesn't work. Our experience is the best managers out there are capacity constrained and know their capacity limits. And therefore, it's really critical to find those good managers, get good access to them, and lock in that access on behalf of your clients. If you're buying bulk beta, then yes, scale helps a lot. But if you're trying to find hard-to-access managers, particularly hard-to-access hedge fund managers or private capital managers, those managers, again, are very smart, very astute, and very disciplined in the amount of capital they take in, and bulk just doesn't work there.
So, Sarah, you alluded to the future in one of your previous comments, and I promised we would double-click back on that. So, just as you suggested, all the research and the surveys that we studied that I'm sure you've seen suggest this freight train is only going to continue. And that's based on a number of things that we've already mentioned, this increasing focus on skill-based or alternative strategies, the increasing pace of change in the industry, technology, cybersecurity demands, access to elite GPs, as Mark just mentioned. Is this your expectation for the trajectory of the business as well from this 3.5 trillion state on?
Yes, it is. And I could share a little bit more with you if you'd like about what is changing, if that would be helpful. So changes in client preferences, we think are going to continue to drive this. Public funds are much more sophisticated than they ever used to be. These are really, really smart investors. The staff is asking for more data and more access to portals, manipulating the data themselves. In Taft-Hartley, these are the union clients. These are clients that have difficulty managing their capital calls. And that either requires operational support on their spectrum of services or something else. They also really struggle with the degree of complexity, and ERISA wrapper can be really useful so that they can be a fiduciary for clients without worrying about getting into trouble in the way that they're running the portfolio. They can give it to us. In healthcare, technology, everything's digital. We at NPC have our own proprietary technology called CAIA that we're using with our healthcare clients. That's really all they care about. End results. But technology is really important to them. With endowments and foundations, we are finding that there's a lot of turnover in the endowment and foundation market. Community foundations want more mission alignment and more private markets, and all of these things. The turnover is a risk for a lot of reasons, and that would be mitigated with an OCIO mandate. And then with the community foundations wanting more mission alignment, more private markets, that's not easy to do on your own. In private wealth, there's a major generational shift. It's really leading to demand for more technology and increased interest in operational support. Overseas, private wealth family offices are less professionalized. There's more of a demand for structural and governance support. And then when we really think ahead, and I'll probably allude to this later, in the private wealth space, that next generation who's going to be taking over, those portfolios, when the initial wealth creator has an event, their priorities are likely to look very, very different from the wealth creator in the current generation. I talked earlier about corporates. They really want tools and data on their desktops. They need day-to-day updates on their funded status. So that's an area that often goes under the radar, the operational complexities of running a corporate plan, and something that committees may not even understand. So the staff at corporate plans are really overwhelmed. And then defined contribution, it's really all about governance advice and record keeping. The DC space is probably by far the most litigious. There's millions of individual investors, and this is really feeding ground for attorneys doing class action lawsuits for even the smallest misstep. So an OCIO model really reinforces a sound process where the sponsors can take steps to make sure that they've followed ERISA guidelines. So those are the things that we think will continue to drive OCIO going forward across a number of client types.
Well, and looking at this going forward as well, Mark, just thinking about Sarah's points, I'd like to put probably my favorite question that we ask anybody to you and say, what are the capabilities that are the most important for today's OCIOs to capitalize on? And to me, more importantly and more interestingly, what are some of the challenges that concern you in this very much so increasingly competitive market?
So 2 good questions wrapped up in one. I'll try and divide them. Actually, let's come back to something Sarah said. It's a very important point that she raised, and I totally agree with it, and that's the governance structure. All too often, again, we talk about strategic asset allocation, we talk about selecting good managers, we talk about getting great access to private capital. Sometimes the governance structure was overlooked. One of the things we do at Commonfund when we sit down with a new engagement, whether it's an endowment or foundation, we talk about dividing up the trade tickets, and we actually call it that with our clients. Who's going to have responsibility for what? What are we going to own? What trade tickets do we own at Commonfund versus what trade tickets the investment committee may own? We make it very clear up front what is the governance structure under which we're going to operate going forward. That helps alleviate misunderstandings, misconceptions, or just breakdowns in communication going forward. And that wasn't really tied into your question, but I wanted to come back to it because it's really a thoughtful one. And as Sarah was indicating, as more and more mandates are going to an outsourced CIO, whether it's an endowment, a foundation, a pension fund, a DB, a DC plan, whatever, getting that governance structure right up front is really critical to successful OCIO engagement. So wanted to throw that in. Back to your 2 questions. I think the first thing is we continue to see competitive pressures and the fee pressures across the whole industry. And Sarah said this earlier, clients all want more for less. But at some point, you have to toe the line because there is a breaking point about what you can actually provide based on what the client actually needs. And there have been a couple occasions when we've been said, gosh, Commonfund, if you'll just cut your fees another few basis points, it's yours. And we've had to say, gosh, we're not comfortable doing that simply because we think at that point we won't be able to sufficiently source what you need to manage this portfolio. And there's been a couple engagements we've lost simply because we wouldn't cut our fees down to what they demanded. But that pressure will continue. And it's not unique to the OCIO business. It's going on across the industry. My gosh, you can even get some fee breaks in private capital nowadays. If you get in that first close, Sarah, you probably know this, come into our first close and we'll give you a fee break. So that pressure's everywhere. I think what do you really need to be successful? The trend towards more private capital and capturing that liquidity premium, that continues to grow. We see that as a topic of discussion at almost every investing committee. We see more of our clients willing to go up in terms of taking on more illiquidity or investing in more in private capital. One of the things that we have worked very hard on and continue to develop are stress tests to clients' portfolios. How much illiquidity can they take in their portfolio and still withstand a shock to the system such that they can meet either their philanthropic donation schedule or their spending needs for a university? That's becoming more and more critical, are the simulation analysis and the shock analysis based on different levels of private capital commitments. Let me stop there. That was a lot, but hopefully got to the nature of your question.
No, that was great. And you'll never hear me complain about talking about governance. So I loved that.
Excellent.
Mark, really helpful. I think it's just amazing how much more is demanded in today's world. And as the stronger getting stronger, by definition, as this continues to concentrate, we're going to get back to that question about M&A in a moment. But Sarah, before we do that, as I dug into this research, obviously I knew the OCIO business, and it's increasingly on the hearts and minds of all of us practicing and certainly in the news flow. But one of the tensions I just have been wrestling with throughout this research in preparation for this episode is that in the other parts of my world and in my circles, you think of the Canadian model, the Norwegian model, the Kiwi model, and even the US pension funds are actually going the other way. they're the last decade starting to insource more, bringing talent and sophistication in-house. And they might argue to save costs on management fees. They might just say it's better to have those decisions closer to the capital or some combination. So when I hear Christy talk about these tens of billions of dollar mandates that are getting won now, not just the $1 billion and $2 billion Wellesley College types, to cite your history, how does this tension play out? The big game hunting is happening, but some of the biggest games are still insourcing. How do you reconcile all of this?
It's really dependent on the dynamics at each organization. So you have to remember investment committees and these very sophisticated pools of capital, they are governed by a group of individuals, a collection of individuals who are all going to have their own biases and their own perspective about the way things should be done. In the case of public pensions, there's certainly going to be some degree of political influence coming into that, because I don't know of many public pensions who don't have somebody in a political seat on the board, an investment committee. So short of privatizing, like some of these organizations, it's really difficult to make the case to bring the entire thing in-house. But really those same questions apply as to whether to insource or outsource. Having worked for years as deputy CIO at a $100 billion public pension fund, I can tell you we spent a lot of time evaluating that decision whether to manage assets in-house. And a couple of factors were at play. It's really difficult to pay enough money to attract the top talent that can source deals that are going to do really well. Or if it's a public market investment mandate, to pick the right stocks and outperform. And especially if you're in a financial hub like we are in Boston, where there's a lot of competition for talent. Now, some plans can do it for a variety of different reasons, but we found that we really couldn't. And the other is that access matters greatly, but it's not available to all. And it takes a tremendous dedicated effort and a strong brand to access the best GPs. So in some cases, these plans are subject to FOIA, which are not preferred for GPs, whereas an OCIO structure can get better access for a pension and remove that. There's also, if you are bringing deal selection in-house of private market portfolio companies, you're now a competitor to GPs and have lost that stream, that flow of information. When it comes to that access as well, really big selling point for GPs is having one touch point and getting many clients invested with that one touch point, as opposed to having, if we bring 20 LPs forward to a GP, we're that point of contact. They don't need to have 20 meetings, they can have one. And we're consistent providers of capital. So Outsourced CIO provides another advantage there relative to doing it oneself.
Well, and on the flip side of that, one of the things John mentioned earlier is that Mercer pulled off a bit of a coup late last year with their acquisition of Vanguard's OCIO business. So a move that basically cemented them and their increased lead in the space. So, Mark, do you expect an acceleration in the M&A arms race? And will everyone need to scale up to compete in this space in the future?
My gosh, the asset management industry in general has undergone continuous consolidation. So why should the OCIO business be any different? It's another branch of asset management, and you would expect consolidation to happen. Particularly as Sarah and I have been discussing, there are a few pressures on her business and in mine. Those will continue. There is, as I said, some advantage to scale, particularly in the back and middle office size. I don't believe there's a lot of advantage to scale in manager selection, particularly for good managers who are capacity constrained. So the scale really comes in managing, like I said, the back and middle office, but that will continue, I think. So that's part one. I think part two to the response is there is an antidote to scale, and the antidote is innovation. So at Commonfund, our goal is not to be the largest. We know we're never going to be the largest player out there. So as a result, we realize we have to be smarter. We have to offer better service. We have to make every client feel like Commonfund operates solely for their benefit and they're just not one of thousands. We agree and we know for some clients, scale and size is going to be right in the middle of their comfort zone. They're going to go with a huge provider because that feels safe for them. And that's okay, because we know there's another cohort of clients out there who want innovation, who want elite manager access, who want the attention that a dedicated and focused shop can give them. So there are some clients out there that don't want to be one of several thousand. They really want to have that focused time and attention. So that's to whom we market and hopefully appeal.
There certainly is plenty to go around. That's become clear through this research. It's funny, in looking at those numbers that Christy just cited, Mercer just bought 2 common funds in the Vanguard OCIO business. So it's just amazing how big these transactions are getting. So now the fun part as we close. Typically people will say crystal balls. I'm going to ask that each of us go into our cryo chambers for 10 years. And we've hinted and foreshadowed a lot of what we think is going to occur and progress and change in the coming years. I think the consensus is clearly this is up and to the right. But what do you think would be the biggest surprises if we were to wake up 10 years from now? And maybe I'll start with you, Sarah. Is there anything that you think will have come of age or have exploded or become a new emphasis that maybe is just a minor part of the dynamic currently?
Yes, there are several things that I can think about. The first is there are probably going to be at least two major multiple standard deviation events that we can never imagine that's going to change the way that we approach investing. We can't know what those are going to be, but it happens all the time. The other is that technology is likely going to completely change the face of our work and what we do and the cadence of it. The pace of technological change right now, we know that Gen AI is not ready for prime time yet to be incorporated into processes where precision matters. It should be treated like 1,000 interns. You can get a lot of work done, but you need to check the work, especially if the stakes are high, like entering a trade or something like that. But the pace of change is much faster than any of these AI developers expected 20 years ago. So I think that we have no way to know where we're going to be, but we'll be really surprised at how much has changed. And then private wealth is likely to be a very fast grower percentage-wise. And the next generation of wealth owners is going to want something very different.
How about you, Mark? When you rise out of that cryo chamber, what are you going to see that will shock us all?
Whether it's a cryo chamber or a crystal ball, my crystal ball is just as muddy and murky as everyone else's. I wish it came in high def, but it doesn't. I think a couple things. First, we've already talked about it. There'll be more consolidation. It's bound to happen. I think the Mercer Vanguard acquisition is just the tip of the iceberg. I think there'll be a lot more of this going on. More consolidation is only natural. We've seen it already in the broader asset management industry. We'll continue to see it in the OCIO business. So that's one. On the humorous side, I think in 10 years' time, we'll probably have another 24 OCIO providers claiming to be the original OCIO provider. So can't wait to see who those might be. And then I agree with Sarah. I think artificial intelligence will be a differentiator. And not only in terms of generating better performance, but also better access and better service model. Hard to know how that will play out quite yet, but clearly it will be a driver of us offering more services, being more competitive, and being able to provide just that more services at perhaps a lower fee base through the use of artificial intelligence.
Well, we'll have to develop a futures market on those cryo predictions right there from Mark and Sarah. Listen, it is an absolute pleasure, as always, to see both of you. This has been really instructive, a whole lot of fun as well. Thanks so much for joining. And listeners, stay tuned for the final sip.
A pleasure. Thank you, everyone.
Thanks, everyone.
Thank you.
All right, listeners, welcome back. Final sip of this episode of Capital Decanted on the OCIO. Christy, that was so good. There's so many threads to pull on. I'm not even sure where to start, but how are you feeling? Where does this leave you? I know you came into this with one historical sense of worth and value and maybe formula on when and why this works, but I'd love to hear where you are now.
I really appreciate that after talking to them. I think that the OCIO business segment as a whole has just grown leaps and bounds first and foremost, but also just in the way that they approach clients, I think is very much so more personalized, more individual than I expect. And I don't think that that's true of all OCIOs, to be very clear. But I think anytime both people that we're talking to just really drive home the importance of things like governance, which is a thing that is very much so at the center of building a solid investment program, I'm there. I will say I still don't think that it's the right choice for everybody. But again, it just comes down to trade-offs. I think that the business offering is good for the most part. I think that especially if you find a group that works well within your organization and understands your needs, I realize that it can be a very powerful business offering. And I just have a lot of respect for our guests there. What about you?
I agree with everything you said. Governance was definitely a theme. They both really hit hard, which I wouldn't have thought as much about coming into this. I think we talked a lot about this consolidation and the entry of these newer, larger players, the winning of larger and larger mandates that has shaken up the marketplace. And I wonder whether what struck me through the conversation was whether this market is bifurcating into two worlds. The hurdles monologue on true OCIOs may still apply. And you heard Mark channel that, the idea of independence and intimate customer service and being a very close friend and feeling part of the family in that traditional segment of small subscale endowments, foundations. But then there's these major players where they're insourcing major investment offices, transitioning. So the levers and the conditions of BAE Systems or British Airways too that you cited to transition their entire operations over to Goldman or BlackRock is a completely different discussion entirely than, for example, my alma mater, University of Mary Washington, having just decided a higher hurdle at $85 million to $100 million. It's just, we're talking a completely different conversation. So the other thing, though, that struck me that really somewhat surprised me was perhaps even a throwaway comment, but I thought it was really insightful from Sarah, which is the moment you start insourcing bits and pieces of this, your identity changes. And it could cause a little bit of raised eyebrows from your GPs. Are they insourcing me? But maybe even worse, are they insourcing some of me and therefore competing with me? And then you've got an identity change and perhaps a change in the dynamic of your relationships with your existing GPs. And I'm just curious, when you think about what CalSTRS is doing, for example, on building significant private capital capability, what Commonfund has done in building their own private capital capability, how do you think that dynamic plays out with existing GPs that they've used traditionally?
That's, again, a murky crystal ball question. I am hesitant to say it is good or bad because, again, I don't like to think in that dynamic. But I will say I'll be interested to see how it's executed because I think more than anything, this relationship in that part of the industry in particular on the institutional side is still very much so run by relationship dynamics. And the relationships and the politics, those things actually really do matter. And it's funny because they brought up AI as the crystal ball looking forward. And there's only so much that stuff can replace. And there's only so much insourcing one can do in the OCIO world before it does potentially run afoul of your business or run counter to what maybe some of your other constituents or stakeholders may view as the best outcome. With that said, I think as long as you have a good process, as long as you have a good and defendable governance structure, I think a lot of times I appreciate that this industry looks at it as this is business and this is the direction that the wind is moving and you either adapt or die. So if you are paid for what you bring to the table, which is ultimately what we say in our capitalistic society, that you have to actually bring positive, whether alpha or investment returns or something to the table. And if an OCIO believes that they can do that better, then adapt or die. I know there's such a dog-eat-dog world view of it, but I'm still hesitant to.
No, it is. I'll be interested to see how this consolidation plays out because it's one thing for Vanguard's OCIO division to be bought out, or let's just say one of the major multi-division banks to sell their OCIO. But it would be curious to watch when one of the independents is first bought by one of the major consultants, because that changes things completely. And all these cultural questions and challenges and perhaps claims of which is right and which is wrong start to get very real and they start to conflate. So I'd be curious to watch not only how fast the consolidation is going, but whether that bifurcated world starts to merge a bit, because we haven't seen that quite yet. So more to come there.
It'll be weird. I did also love, I'm going to paraphrase Sarah's point, but it's one that I also believe is near and dear to my heart. While I believe that fees are, you get what you pay for, the basis point saved is a basis point earned effectively, I think is a really great insight as well, particularly as we move forward and we pay for returns, but they better be good and something we can't get elsewhere.
Yeah, no doubt. That was a good one. So listeners, as you know, we choose a fun question to get to know each other a little bit better. We have done favorite book, Christy, a few episodes ago, and we're going to go with favorite movie of all time here now. So I'm going to let you go first.
So I love old movies. And within that, I started watching through AFI's 400 greatest movies of all time, which is actually a really great list. And there's a lot of old stuff on there. But I will say within that list, as I was thinking about it, I really love old Hitchcock movies. So probably Vertigo is my favorite. Rear Window is also great. Psycho is what everybody knows him for. Also a good movie, but just the oddness of it. Or even also I like old film noir. So it's like women's modern day murder mystery or murder genre, but movies and set in 1930s. So think like Strangers on a Train or Dial M for Murder stuff. What about you? What's your favorite movie?
Ooh. So you didn't name the Hitchcock movie that still gives me PTSD, because I don't think I've shared this with you, but I have a unhealthy psychological fear of birds still to this day. So that movie, my goodness, that I can't even watch it. So there you go. I've answered 2 personal questions with this one.
Sorry, I didn't mean to ruin it. That's so scary though.
No. So Christopher Nolan, the director, has finally become a household name. Everybody knows who he is now. We had the big Oppenheimer biopic last summer. And by the way, it's about time. He should sweep the Academy Awards. Coming up, it looks like he likely will. But Nolan's been around for 25 years, and he's just been very unique and very different. So he hasn't gotten a lot of what you might call blockbuster fanfare. He obviously had the Batman trilogy back in the mid-2000s, but I just still don't think a lot of people realize his brilliance is in these complex, multiple timeline type stories that he was really known for earlier in his career. And my favorite, I think, although this is very hard, my favorite, I think, is Inception. I also love Leonardo DiCaprio, who's also terribly underrated, but amazing film. And it's one of those films where you have to watch 5 or 6 times before you really get it. And I've probably seen it 30 times and still am noticing new things that connect dots in ways that are just, the art and the writing is just out of this world. And I have a lot of admiration for people that do things that I'm clueless about. And Nolan's one of them. So there you go.
I think that he recently did an interview about the ending of that movie and actually explained it. So I just saw the headline. I don't know if we want to do spoilers or anything. I think I've seen the movie all the way through once and liked it, but I was just like, I don't get it. I could see why you have to watch it 30 times. I don't get it because it's like a great movie, but there's just so much detail and it's so rich. He is a great director for sure. Great choice.
Amazing storyteller. Interstellar is another one that probably is even more difficult to understand with Mr. Handsome McConaughey. You got to watch that so many times to get it. So that would be a close second of my favorite Nolan movies, but there you go. I'm a bit of a fan club on Nolan.
Interstellar made me cry so hard.
Oh, yeah, absolutely.
I was watching it on a date with my now husband, and I have a 9-year-old daughter. And so just all of the interplay with him and his daughter, I started bawling.
Brutal. I agree.
And couldn't stop. And he felt so bad because we had only been dating for a couple of months at that point. And he's like, I'm so sorry. And I'm beside myself. But just the movie and the music and just phenomenal.
Amazing. I'm with you.
Worth the tears on 8th date or whatever.
Yes, indeed. All right, Christy, it's been a blast. As always, that was fun. The research all the way through the last couple hours. Listeners, I hope that was helpful. And we'll be watching this space. This is one that I suspect we may circle back and cover again at some point on Capital Decanted, because this is just the first chapter, I expect. So thanks for tuning in. Thanks for hanging with us, and we'll see you on the next episode.